Hello, D2, and welcome to Tax Talk 2.0. We've had enough requests after my initial tax video to put something else down, and you guys can view this at any time with some additional tax ideas to consider for 2021 and beyond. So let's frame the landscape. We are in a position where more than likely taxes will increase on most of our successful clients beginning January 1, 2022. Specific loopholes that people have been threading for years may get closed, and high income earners are always looking for a way to save money on taxes. Remember, it's not what you make, it's what you keep. So here's a couple of ideas to run by your top clients and their tax professionals. One, it's the old, there's nothing new under the sun. Before there was a 401k plan, there was a pension plan. And if you look at some of the Biden tax proposals about having to pay full bore Social Security taxes on wages over $400,000, an idea would be to familiarize yourself with the old-fashioned cash balance pension plan. This would be something more than likely you wouldn't want to put into place in 2021, but you would want to educate yourself how it works, educate your top clients, CPAs and tax professionals, and be ready to implement a cash balance plan for huge amounts of tax savings in 2022 and beyond for your top clients. Secondarily, another strategy that is often overlooked is clients that have huge amounts of capital loss carry forwards. So these are clients that we're dealing with kind of a bad investment person or a bad deal. They've got an amount of capital losses that their CPA may say they'll never be able to use. And depending on what happens with the capital gains taxes and capital losses going forward in the Biden administration, one thing you can always go back for is remember, options, covered calls, are taxed as short-term capital gains. If you can write a covered call every month or every other month and systematically generate cash flow for someone that has a huge capital loss carry forward, that would be a good thing, because generally speaking, it may mean they may not have to pay any income tax on that. Always check with their tax advisor, but that is another thing to consider. Going back to business owners, if they're concerned that the Section 125 depreciation and special depreciation allowances get phased out, if they've been able to purchase vehicles and equipment over the last 4 years and have strong cash flow, that's your perfect candidate to take those dollars, quit buying equipment, and start saving for the future in a fully tax-deductible cash balance plan. Finally, this. It's not always getting the tax break on the front end, but maybe on the back end. If you have clients and tax professionals that can think in the long run, one thing to consider is identify those employers around you that offer an after-tax feature in their 401k plan. Okay? This is not a Roth. This is a true after-tax feature. Because what the IRS says is if you're over 50, you can really put back about $63,000, $64,000 a year, not just the $26,000 that we're familiar with pre-tax or Roth contributions. So total contributions can be in the mid-60s. If you're under 50, you can go in the high 50,000s per year. But the rest of that money, not the pre-tax, not the Roth deferrals or the company match, has to go in as after-tax money. That's money that can be converted to a Roth irregardless of income limits, and give your clients more tax-free money in the future. Because if you're thinking about this tax deal in the long run, what you know is we're probably just at the tip of the iceberg. At some point, we're going to have to pay for everything that's been created to help us get through this mess, and higher taxes are definitely probably part of that formula. Good hunting. If you need any help with this, reach out to John Randall or myself. And as always, talk to any of your D2 coaches. And remember, if you don't know about the D2 digital experience, reach out to Katie Rotz or your coaches for that as well. That's a great thing D2's doing. Have a great day.